Okay, now this is the last, not last, before the last, the theory session discussion on SL3 corporate taxation. Now we have done a series of the discussions starting from the non-resident taxation, and after that I have addressed the important areas of the tax administration, which is statutory provisions, the assessment, time bar provision, penalties, and the tax administrative review. And after that, as promised, the transfer pricing, the gazette notification, and the basic requirements of the transfer pricing I am going to discuss with you all. The reason is now from even this time for June 2021 examination, you all testing the without the amendments. Therefore, from the revision session of 2020, which I have done from pilot paper, to now, I have done the pilot paper discussion with theory and the revision. The most of the areas I have covered. In that, what are the areas I have not covered, I am going to capture here. Then if you are looking for entire the webinar series, you have to start from the pilot paper. This is a revision part of it in 2020, and in that period I have done. But even in the VAT question, the only thing is a rate change, it's 8%. When discussing the pilot paper, it was 15%. Other than that, all are in the same manner up to now, not for your next examination. Then therefore, what I have done previously is linked to for this one also, because it's I am going to do, and I have done it under the series of lectures combined up to now. Okay. Then in that sense, I have done the company taxation, VAT, and tax exemptions, a little bit of the case law provisions through March 2021 exam paper discussion and the December 2020 online paper discussion. Then all these things in methodically done. Then what I have missed are these areas, which are non-resident taxation theory and the statutory provisions, very important theories, as well as the transfer pricing, which I really need to do, but at that time I did not have time, but now I have time. Then I am doing under this the discussion series the discussion of the transfer pricing. Okay. Then this is coming under tax planning and advising part. In that tax planning and advising, tax exemptions, the enhanced capital allowances, investment incentives, the second schedule and the sixth schedule, qualifying payments, all these things you all know, and most of the areas I have discussed. But this part, even in the pilot paper, there are questions. Then after doing this, please go through that part again as the quick revision to these theoretical areas which we are going to discuss now. Okay. Then today, as the next area of the theory discussion, I am selecting the tax planning and advising, which is 10% of your syllabus area. In that, most of the areas already I have discussed, but I need to discuss the transfer pricing regulations. I need to do a small change to this theory session outline. I need to add contemporary issues in taxation, because in the very recently the ethical principles and taxation has tested. Then I thought it's a whatever the things in the study pack I am going to discuss with you all. Then after that, that's I told you all, this is not the last part of the theory discussion. There is few parts which is contemporary issues in taxation. Okay, then now we will look at the transfer pricing regulations. Then this is theory session 8 on transfer pricing regulations. The transfer pricing regulations. Lamai, what is this transfer pricing regulation? Why it has become a regulation? Before go for this transfer pricing thing, you should know what is the situation that transfer pricing issues can happen. First thing, the transfer pricing issues can be happen, the transactions in between associated undertakings. How it happens, the transactions in between associated persons. Transactions in between associated persons. Now we need to look at, during our discussion, we need to look at who are these associated persons. Now already Lamai, you all know under section 196, we have discussed in the section 196 of the Act, we have discussed the associated person definition. But going forward on that, in the Gazette notification, it has defined the associated person for transfer pricing, not for all, but for the transfer pricing regulations. Now, first thing, to have a transfer pricing issue, there should be a transactions in between associated person. There are many transactions in between associated person, but why there is a transfer pricing issue? The reason is the particular transactions may not, we don't know, may not in arm's length pricing. Arm's length pricing. This is the second issue. There are transactions in between associated person done. In that transactions, there is no arm's length pricing. There is no arm's length pricing. Now, we need to look at, okay, why there is not to be a transfer pricing issue, there should be issue, no? Then without, by not having arm's length pricing, what's the issue? Due to not having the arm's length pricing, there are tax mitigation strategies. Tax mitigation strategy. Now here you need to look at in the whole group concept as well as the both party concept. You have to look at tax mitigation strategy. Did they even not, this is tax mitigation, I need to add, this may be tax evasion, maybe the agreements, maybe the arrangements to evading taxes willfully, intentionally. Then tax mitigation strategies are there. Therefore, tax liability in Sri Lanka, tax liability in Sri Lanka going to be reduced, Now this is the issue, this is a transfer pricing issue. Every time please note that Lamai, the transfer pricing issue is coming with transactions in between associated person, not with the third party, not with third party, not with third party. Clear? Then you need to look at, this is where how you all analyze in the question. You need to look at whether there are transactions between associated person. If it is yes, then you need to look at, okay, is these transactions are in the arm's length pricing? If it is no, you need to look at, okay, due to this arrangement, whether there is a tax reduction or tax evasion. Then if there is a not in arm's length pricing, one way examiner testing you, if there is no arm's length pricing, examiner tell you to suggest to have a better transfer pricing policy in the company. The suggestions you have to provide how to mitigate. That means what is the suitable transfer pricing, transfer price, not pricing, what is the suitable transfer price for this transaction. Then this, when looking at this arm's length pricing, the Gazette notification which is issued on 31st December 2018, it has mentioned 5 pricing strategies. Then you need to look at that 5 pricing strategies. Now it's a one angle, it can be tested. Second one, the mitigation, and you need to test the entire thing. there is a transaction between associated person. Due to this transaction, this is not under the arm's length pricing, therefore there is a reduction of the income tax liability. Then you have to analyze the scenario and tell your recommendation. It's a one way that it can be tested. Maybe the pricing adjustment also they can give, but up to now in the past papers, in the history, likewise it has not tested. Again, Lamai, when it comes to the transfer pricing, transfer pricing can be divided into two. One is international transfer pricing, transactions in between the associated person, which in international, I will summarize it, international transfer pricing and the domestic transfer pricing. Domestic transfer pricing. International transfer pricing, section 76, domestic transfer pricing, section 77. Then, when it comes to your examination, this two can be tested in whatever question. Most of the cases, this international transfer pricing and domestic both can be tested with the question 1, which is your non-resident and international taxation. Maybe question 2 and question 3. That's what I need to tell in the anywhere in the paper. This can be testable. This is within your syllabus. Okay, now next you need to look at, other than the laws mentioned in the provisions mentioned in the Indian Revenue Act, there is a gazette notification. Gazette notification, but by telling the regulations of transfer pricing, then we need to study, highly you need to study that gazette notification, which is open book referential for your examination. Okay, clear? These are the things I am going to discuss with you all. As the question, as the Patrice question, please go through the pilot paper question 1, which I have already discussed. Please go through that pilot paper question 1. I think it's part C. Part C, please go through that, and in that I have mentioned all these things and explain with the theory little bit. More concern on the answer format and the answer, the approach to the answer, and very detailed answer is there. Please go through that one. Okay. Now with this understanding, I need to start the transfer pricing regulation. Before go for section 76 and the 77, I need to go for this the arm's length standards and the arrangements between associates with section 33. Come to this discussion, transfer pricing regulations. In that I am going to discuss first thing, arm's length standard and arrangements between associates, section 33. Secondly, section 76, very importantly, profit and income or loss from international transaction between associates. It's on international transactions. It's on the international transactions. Then next one, section 77, profit and income or loss from transaction between associates. Then 76 for international, then indirectly 77 for the domestic. That's why it's for the domestic transactions entered with associated undertakings. Clear? Then fourth one, discussion of gazette notification number 2104/04. This is issued on 31st December 2018 by telling the regulations of the transfer pricing. These are the areas I am going to discuss with you all. Then for truly speaking, for the gazette notification, I am not going to discuss all paragraph 1 to, if there are paragraph 20, I am not going to discuss all, but take in the important topics, important part of the gazette notification, I will discuss that with you all. Then come to the section 33 discussion. arm's length standards and arrangements between associates, section 33. This is one of the key provisions telling us that if there are transactions between associated person, it should be in the arm's length. If it is not in the arm's length manner, the Department of Inland Revenue can take necessary actions to take that transaction to arm's length. Okay. Can you remember when we are doing the March 2021, the question 1, in that there is the transfer pricing adjustment given in the first time for your examination. Then it has added to the tax liability, then it is reason for the increased tax liability. Clear? Now such kind of the adjustments can be done. Then come to this part, where an arrangement exceeds between associated person. This is highly important because it's a key thing. Its issue is arising due to the transactions in between associated persons. The person shall calculate their income and tax payable according to what standards lamai? Arm's length standard. It should be at a fair market value. For very simply, it should be at the fair market value. Secondly, the arm's length standards requires associated person to quantify, characterize, apportion and allocate amounts to be included or deducted in calculating income to reflects arrangement that would have been made between independent person. This is very important provision. In here very clearly telling that if there are transactions between associated person, the two persons who have done this transaction, they should ascertain the transaction, the characterize, quantify, apportion the transaction, like how? If the transaction happen in between whom? Independent person. The third party, independent person, if I have done this transaction, what the value of this transaction? The same value shall apply to the same or similar after doing some adjustment according to the organization, according to the business, according to the undertaking, then it should be matched with the arm's length pricing. The simple thing, every time you need to compare it with the independent party. Okay, that's the second thing. Third, the Commissioner General may by publication in the Gazette. That's why the 2104/04 Gazette notification is important. It has published. Specify the manner in which arm's length agreements may be entered into for the purpose of determining arm's length price. Regulations. Transfer pricing regulations is prescribed by the Gazette notification. Now, after this session, we will look at that Gazette notification. Now, this is a continuation of the arm's length standards and the agreements between associates, where in the opinion of the Commissioner General, a person fails to comply with about the Commissioner General may make adjustment. See, the Commissioner General has power. If two associated persons have done the transaction, but it is not in the arm's length pricing, thereby the Commissioner General has power to do adjustment. Power to do adjustment in compliance with above, and Commissioner General may. What are the things Commissioner General can do? What are the Commissioner General's the steps what he can do? A. Recharacterize an arrangement made between associated person, including recharacterize debt financing and equity financing. He can recharacterize the agreement according to the market value. He can recharacterize the debt financing, equity financing. For an example, if if there is a loan between associated person. Now the interest rate charged for that loan is there is a borrower, there is a grantor. The person who given the loan and the person who take the loan. Now here the loan has given for the interest rate of the 6%. But the Commissioner General can take the interest rate, the current interest rate may be 8%, 9%, this kind of the transaction. Then thereby, what Commissioner General is doing, the 6%, he taking that into the 9%, the 3% increase in the one part is a finance cost, other part is a finance income. Likewise, he can recharacterize the transaction according to the market condition. Part B, recharacterize the source and type of any income, loss, amount or payment. Not only this, the arrangements, the debt financing or equity financing, the source and type of income. Any income, Commissioner General can take into the fair market value. Any loss, if there is a high loss, then he can reduce that loss and amount of payment. The purchasers and one party, the two associated person, one is purchasing from another associate, then purchase, it's an expense, other party it's the credit or creditor. Then thereby, if there are arrangements, due to that arrangement, if there is a the value of what cost of the purchase is high, then it's the coming to the loss of the company or loss of the GP, the reduction of the GP. Then other party maybe it's a purchase and the one part is a purchase and the creditor, other party it's a revenue and the debtor. Then for other party, if the second company is a tax exempted company, they are having a high revenue, but it's not subject to tax. Such kind of the arrangements can be done. Then Commissioner General can recharacterize all these things according to the fair market value or arm's length pricing. C, apportion and allocate expenditure based on the turnover, the proportionation of the expenditure he can do. Okay, these are the things that CGIR can do. After that, we need to look at section 76 and the section 77, the two, the particular pricing, the transactions in between international transactions as well as the domestic transactions in between associated person. Now, first thing, we knew that under section 33, all the transactions in between associated or all the arrangements in between associated person should be in the arm's length. If not, the Commissioner General can do these things. Alumni, I need to link the last session I have discussed the penal provision relevant to transfer pricing, not preparing the transfer pricing documents, not submitting particular transfer pricing document, inaccurate documentation, all things I have discussed. Please link that part to here also. Then I am going to discuss the international transfer pricing. Come to here, section 76. Profit and income or loss from international transactions between associates. See the wording, it is between whom and whom? Associates. Come to this. Any income, gains and profit arising in, derived or accruing from, or any loss incurred by any person in Sri Lanka, engage in any, underline or highlight this one, very critical, any what transaction lamai? International transaction entered into with its associated enterprises shall be ascertained having regarded to the arm's length price. Any transaction in between the person in Sri Lanka had with person outside Sri Lanka, the two persons are associated persons. In that sense, what the law is telling, ascertain having regard to what? Arm's length price. It should be under the arm's length price. That's the first thing. Now, that's why in the examination you have to look at, are there any associated person? If yes, are these transactions are in the arm's length pricing? Then next one, I told you all we have the general definition under section 196 for the associated person. But for transfer pricing purposes, some definitions are given. Even in the transfer pricing gazette notification, the definition of the associated person given. In that situation, Lamai, don't go and apply this section 196. Go for the definition specifically given for the transfer pricing. If there is no such definition, go for the common definition. Okay, come to here. I am still in the discussion of the international transfer pricing. In that, definitions for the purpose of this section. Any business organization that has a PE in Sri Lanka. That's why I have told very specifically the section under section 76 and 77, even both the under the non-resident taxation and the international taxation part, this can be tested because due to this reason. Come to here, any business organization that has a permanent establishment in Sri Lanka, now all of you know these things, shall be deemed to be a person for the ascertainment of income, gains or profit arising in or derived from or any loss incurred in Sri Lanka from such permanent establishment. Under international transfer pricing, one of the key base is the transactions in between what, Lamai? Permanent establishment. What is the definition of the permanent establishment? And I will add the two words in front. The Sri Lankan permanent establishment, and under double taxation treaty we have discussed the different permanent establishment, the service PE, the fixed PE, construction PE, dependent agent PE, lot of PEs we have discussed. Then the PE in terms of the international taxation, it is whatever the fixed base or service PE or a construction PE which belongs to the non-resident person, which is located in the contracting that the other than the country that person resides or a resident. Then if there is a PE exposure, then there is exposure to what? International transfer pricing. What is the definition of the permanent establishment for this section? Very specifically for transfer pricing requirements, for transfer pricing definitions, transfer pricing regulations, the PE has defined. Come to this, Roman 1. In relation to a country with which an agreement has been entered into on avoidance of double taxation means a permanent establishment defined in an agreement. If there is a DTA between Sri Lanka and other concerning country, then you should go for the definition of the double taxation treaty. As usual, Lamai, if there is no double taxation agreement between Sri Lanka and that concerned country, you have to apply what? The provisions of the Inland Revenue Act, more or less section 195, definition of the PE. Clear? Then a permanent establishment defined in an agreement for the relief of double taxation where an agreement is in force between the government of Sri Lanka and the government of any territory in which any person and their agencies, branches or establishment of Sri Lanka is resident, or in that Roman 2, in relation to a country with which an agreement has not been entered. Now, that is why I have very initially explained, if there is an agreement, yes, you have to go with the agreement. If there is no agreement, with which an agreement has not been entered into, an avoidance of double taxation includes any business connections or a fixed place of business through which the business of the enterprise is wholly or partly carried out, irrespective of the number of days of such business carried out in Sri Lanka. Then you should go by the domestic, what it has mentioned in the Inland Revenue Act, where the PE has situated. Okay. Then see, this is the definition is for the permanent. First thing is we should ascertain the gains and profit on the permanent establishment. Then we have look at what is the permanent establishment, and see any income, gains or profit arising, derived or accruing from, or any loss incurred in any transaction between a permanent establishment and its head office. See, PE, which is in Sri Lanka, head office is the place where in abroad or other related branches in Sri Lanka. Not only the PE and head office, PE and the other branches in Sri Lanka, in which case the permanent establishment shall be treated as a distinct and separate entity from its head office, and related branches shall be ascertained having regarded to the arm's length price. This is telling lamai how we are ascertaining the transactions in between the permanent establishment and international transfer pricing. Even there are head office, even there is a head office, even there are other branch office with relevant to this PE, then these three entities, this should be considered as a separate entities for transfer pricing, or if there are any transactions in between these three, it should be like transaction happen between the independent parties, not like the associated person. Like the same thing is repeating. Then what is the definition of the international transaction? Means a transaction between two or more associated enterprises. Then don't forget, this is again for two or more associated enterprises, either one or both of whom are non-resident. Maybe one person is a non-resident, if not the both of them are non-resident. For an example, permanent establishment and the head office, both of them are the non-resident. The resident company in Sri Lanka and PE. PE is non-resident, resident company in Sri Lanka is resident. Then any transaction, if they are associated, then any transaction between them, it should be taken into consideration. Means a transaction between two or more associated enterprises, either one or both of whom are non-residents, in the nature of purchase, sale or lease of tangible and intangible property, or provision of services, lending or borrowing of money, or any other transaction having been on the income, gain or profits, losses or assets of such associated enterprises, and includes any allocation or apportionment of, or any contribution to any cost or expense incurred or to be incurred in connection with the benefit, service or facility provided or to be provided to any one or more of such associated enterprises under any mutual agreement or arrangement between two or more such associated enterprises. Now, lamai see how long the definition of the international transaction. For this definition, the entire transaction what can be happen between associated person, it has included income, profits, gain, losses, the services, lending, borrowing, intangible property, all provisions, everything. Therefore, any transactions happen in between two associated person, whether one party is a resident, other party is non-resident, or both parties are non-resident, then it should be ascertained regarded to a transfer pricing or arm's length pricing. Then next one, again it's a second para of the definition of the international transaction. Any transaction entered into by an enterprise with a person other than an associate enterprise shall, for the purpose of above that we have discussed subsection 1, be deemed to be an international transaction entered into between two associated enterprises if there exists a prior agreement between such enterprise and other person, and by which the terms of such transaction are determined in substance between such enterprises and other person, which results in the reduction of or would have the effect of reducing the amount of tax payable. This is a very special situation. What is this special situation? It is given even this person A and person B is not associated person. That's why it's telling the transaction entered by an enterprise with a person other than, see the wording, other than an associated enterprise. Even it is that two persons are not associated person, but if there are prior agreements, if there are prior arrangements, there, by doing this transaction, if there is a reason to reduce the income tax liability, then it should be considered as what? Associated undertaking. I think it's clear. Next one, without prejudice to the generality of the provisions of this subsection, the allowance for any expense or interest arising from an international transaction shall also be determined having regarded to the arm's length price. Any transaction in between the two associated persons under the international transaction, it should be determined having regarded to the arm's length. Under this any situation, under these two situations, it should be any transaction shall be shall be taken into the consideration under arm's length pricing. Then we will come to transfer pricing audit. Now transaction has done, it's completed. The international transaction in between two associated persons, it has done. Now transfer pricing audit under international transaction between associates. Where it appears to the transfer pricing officer that the income, gain or profit or the loss have not been ascertained having regarded to the arm's length price, he may initiate a transfer pricing audit. Clear? If the transfer pricing officer, the person who governing the transfer pricing audits in the Department of Inland Revenue, now that transfer pricing officer has noticed that the transactions happen in between these associated persons are not ascertained with regard to the arm's length price, then he can he can commence the transfer pricing audit. Where it appears to an assistant commissioner in the course of his audit that the income, gain, profit or the loss referred to in subsection 1, that means this above paragraph, have not been ascertained having regarded to the arm's length price, he shall refer to the transfer pricing officer for the determination of arm's length price. Then if he rectify that, then he refer to the another transfer pricing officer to take this into consideration. Determination of arm's length price, and if the transfer pricing officer decided to proceed with transfer pricing audit, he shall initiate such transfer pricing audit. Then if there are issues found by telling that these transactions in between associated persons are not done according to the fair market value or not done according to the transfer pricing regulation, these are not under the arm's length pricing. Under that situation, such a transfer pricing officer can commence the transfer pricing audit. Okay. Then next one, under the transfer pricing audit, under international transaction between associates, how to determine the arm's length price. Section 76 subsection 3c. When determining the arm's length price, the transfer pricing officer may in writing address to the person require him to prove the satisfaction of the transfer pricing officer that such income, gain or profits or such loss as the case may be has in fact been ascertained having regarded to the arm's length price. The person who adopt that arm's length pricing standards, according to his view, he should prove to the Commissioner General these are in accordance with the transfer pricing officer. That particular taxpayer should prove to the transfer pricing officer by telling that how am I derived to this value. Okay. Where such person fails to so prove, how am I taken this value for transactions in between associated person and this selected value is the correct arm's length price. If that taxpayer, if he cannot prove that, then transfer pricing officer may determine the arm's length price. Then after that, the transfer pricing officer has power to determine the arm's length price. So, a determination of arm's length price. Next one, the same part in the determination of arm's length price. A transfer pricing officer may give notice in writing. Now, the transfer pricing officer has determined the arm's length price. Thereby, Lamai, this transfer pricing officer shall communicate it to the taxpayer. Hello taxpayer, see, you did not provide me the correct transfer pricing or arm's length price on this transaction. I have selected some transactions from the independent third party for same and similar to this. I have done these plus minus adjustments. After that, done this plus minus adjustments, and after that I have the approach to this arm's length pricing, arm's length price. Okay, that's why it has given a transfer pricing officer may give notice in writing to any person requiring him to furnish within the period specified in such notice information in relation to any transactions between such person and any other person. Okay, it's a communication part. Now, that's the end of the part of the section 76 international transfer pricing. In that we have looked at the transaction should be happen with the associated person. That's the first thing. Second thing, there should be a permanent establishment. Then international transactions can be happen for the transfer pricing purposes in between resident person and the non-resident person, as well as the two non-resident person, like in the permanent establishment. Okay, Then after that we have looked into how to, what's the duty of the transfer pricing officer and the duty of the taxpayer, and the transfer pricing audit, and the how to determine the arm's length pricing under the international transaction. Then I need to come for the domestic transactions in between associated persons. Profit and income or loss from transactions between associates, section 77, domestic transactions entered with associated undertakings. That means it may be two associate company, the registered or incorporated in Sri Lanka, the two resident company, two resident person. Look at the application of the domestic transfer pricing. Any income, gain or profit arising in, derived or accruing from, or any loss incurred in by any person in Sri Lanka engaged in any transaction other than transaction referred to in subsection 1 of section 76. That's mean what, Lamai? It is international transfer pricing. Entered into with its associated enterprises shall be ascertained having regarded to the arm's length price. Other than international transactions, any transactions happen in a domestic way, then it should be ascertained under what price, Lamai? Arm's length price. Then for domestic transactions, how the transfer pricing audit going to conduct? Where it appears to the Commissioner General in the course of his audit, the income, gains or profit or the loss referred to in above described paragraph, that's mean the domestic transactions, the application part of it, have not been ascertained having regarded to the arm's length price, he may initiate a transfer pricing audit. What's the starting point to initiate the transfer pricing audit? The particular transfer pricing officer has understood that these two associated persons not done the transaction under the arm's length pricing. Then to determine the correct arm's length price, they are starting the transfer pricing audits. Then determining of arm's length pricing under domestic transactions entered with associated undertakings. When determining the arm's length price, the Assistant Commissioner may in writing, first you have to communicate it to know, writing address to the person and require him to prove the satisfaction of the Assistant Commissioner that such profit and income or such loss as the case may be has in fact been ascertained having regarded to the arm's length price. Where such person fails to prove, the Assistant Commissioner may determine the arm's length price. Like in the international transaction, the taxpayer should prove to the Assistant Commissioner or a transfer pricing officer, the taxpayer shall prove that, okay, this is the way I have arrived to the arm's length pricing. Then you have to prove that with the documents, the reports, the documentation, which is the transaction category, country by country report. There are a lot of things. Accordingly, if you mean a taxpayer has proved to the Assistant Commissioner that this is the way I have derived to this transfer pricing or arm's length pricing, and if the Assistant Commissioner accept that, then it's done. But if it is no, if the person cannot prove that, thereby the Assistant Commissioner may determine the arm's length price. Okay. The Assistant Commissioner may give notice in writing to any person requiring him to furnish within the period specified in such notice information in relation to any transaction between such person and any other person. To provide that category of the transaction, Assistant Commissioner is in writing should notify to the taxpayer. Then how to determine transfer pricing methods? The arm's length price shall be determined in accordance with the arm's length principles and on the basis of application of the most appropriate method. What are those most appropriate transfer pricing methods? The 5 pricing methods mentioned in the Gazette notification, the control of the comparable uncontrolled method, the cost plus method, the profit or resale profit margin method. There are lot of pricing methods, not lot of, it's a 5 pricing methods given. Okay, then it's according to the basis of application of the most appropriate method as specified in that purpose. It's not defined in the acclamai. 5 transfer pricing methods it has given in the Gazette notification. Situations where domestic transfer pricing shall not apply. Now, we have discussed if there are situation where there is no arm's length pricing, then under the transfer pricing regulation, the tax or assistant commissioner or a transfer pricing officer can recharacterize the transaction by taking it to the arm's length. But if a situation like due to that transaction when we are recharacterizing, if there is a reduction in the tax liability, if there is an increase in of the loss, then something is disadvantaged to from the side of the Department of Inland Revenue. Under such situation, such transfer pricing mechanism shall not be applicable. Come to here, we are talking about the situations where domestic transfer pricing shall not apply. The provisions of this section C shall not apply. Shall not apply in the case where the computation of income, gains or profits has effected of underline or highlight reducing the income, gain or profits chargeable to tax or increasing the losses, as the case may be, computed on the basis of the entries made in the books of accounts in respect of any year of assessment in which the transaction was entered into. If they are due to this adjustment, if there are the reduction of tax liability, the increase of the losses, then some bad things to the from side of the original tax liability, then therefore in such situation this domestic transfer pricing we shall not apply. Okay. Then we need to look at what are the situation where under the transfer pricing we are not providing no exemption nor any other tax benefit. We are not providing any exemption nor any other tax benefit under the TP. Notwithstanding anything in any other section of this Act or any written law, no exemption or tax benefit provided under any of the provisions of this Act or any written law shall be granted in respect of the amount of income, gain or profits by which the total income, gain or profit of the associated enterprise is increased after the computation of income, gain or profit under this section and in accordance with the arm's length price. What it has mentioned, we are not providing any exemption, any tax benefit That's why it has given no exemption or tax benefit provided under any of the provisions of this act or written law. It's telling no exemption, no tax benefit shall be granted. කිසිම benefit එකක්වත් කිසිම බදු නිදහසක්වත් දෙන්න එපා. In what situation? In respect of the amount of income, gain or profit by which the total income, gain or profit of the associated person is increased after the computation of income, gain or profit under this section and accordance with the arm's length price. In that situation, don't give any exemption or tax benefit. Okay. Then I need to come for the definition relevant for the both sections. Definitions relevant for the section 76 and the 77. Now we have discussed section 33, the arrangements between associated person. First thing, it should be transactions in between associated person, and that should be in the arm's length pricing. If not, Commissioner General has power to recharacterize the particular transactions. Section 76, we are talking about what? International transfer pricing or international transactions between associated person. It's a international transaction can be happen in non-resident to non-resident and as well as the resident to non-resident. Then next one is section 77, domestic transactions or transfer pricing in between domestic companies or resident person. In that situation, any transaction other than the international transaction mentioned in section 76, it should be ascertained in accordance with the transfer pricing. If not, Assistant Commissioner has power to ascertain it under the transfer pricing regulations. Now, under section 77, I have discussed some definitions. Now, these definitions, this definition what I am going to discuss with you all, it is applicable for section 77 as well as the section 76. Come to here, definition relevant for section 76 and 77. For the purpose of section 76 and 77, a person, Roman 1, shall be an associated enterprise. මේ person කියන definition එකේ කවුද ඉන්නේ? A person shall be an associated enterprise of another enterprise. If one person participates directly or indirectly or through one or more intermediaries in the management, control or capital of the other person. Now, what's the meaning of the person shall be an associate if one person participates directly or indirectly or through one or more interpose or intermediaries in the management, control or capital of the other person. Secondly, the person is shall be deemed to have been it's an associated person. Again, it should be associated person of another person if one person participates directly or indirectly or through one or more intermediaries in the management, control or capital if such manner or to such extent as may be specified. Then this under this person definition, a person shall include whom lamai? Permanent establishment. In any person definition under general definition of section 195. For the person definition, PE has not included, but for the purpose of section 76 and 77, for the purpose of the person includes what? Permanent establishment. Person includes the permanent establishment. Then this is the definition of person. Now I need to come for the definition of the arm's length price. Arm's length price means for the purpose of ascertaining income, gain or profit arising or derived or accruing from or losses incurred in any other or any transaction operation so is scheme entered into between two associated enterprises calculated in accordance with the arm's length price, as that where a connected transaction is carried out taking into account the terms and conditions that would have been used in the what the wording has given lamai comparable independent transaction. What's the meaning of arm's length price? The any transaction including the losses incurred by the transaction with two associated enterprises. It should be ascertained like how it should be ascertained if I have done the same transaction with the independent third party, like what is the value I have charged to that independent third party. In a same manner, it should be taken that value in between the two associated person. That's why it has given it is the arm's length price. It's like a benchmark price. The price is available in the market. There are, or maybe I am doing the same transaction with similar third party and I am doing the same transaction with my associate. Then for third party, why I am charging one price, for associate why I am charging one price. That's why it's asking. It should be the price where I am charging to third party, same price I should be charged to my associated person. Clear? Then I need to quickly come for the transfer pricing methods. Where this transfer pricing method described lamai, we have to quickly go for the gazette notification. Under Act number 24 of 2017, the gazette notification number 2104/4 issued on 31st December 2018 by prescribing regulations under section 76 and 77. As per that gazette notification, there are 5 arm's length pricing methods. What's the purpose of this gazette notification? It is prescribing regulations. Okay. These are the 5 pricing methods: comparable uncontrolled pricing method, a cup method, resale price method, RPM, cost plus method, CPM method, profit split method, PSM method, transactional net margin method, TNMM method. Then this transactional net margin method, I think it has tested in a March 2021 paper by giving in an unresident taxation, small adjustment it has given. These are the 5 pricing mechanism. Then before for end of the discussion, I need to quickly go for the gazette notification. We will discuss the gazette, then after that this session is over. Okay. Then I am take you all through to the gazette notification. Okay. Okay. This is the transfer pricing gazette notification, which is for you open book referential material. Then this is number 2104/4, which is in December 31st, issued in December 31st, 2018. What is the purpose of the issuing of this? Regulations under section 194 of the Inland Revenue Act number 24 of 2017. This has prescribed the transfer pricing regulations. Clear? Regulations made under section 194 of the Inland Revenue Act number 24 of 2017, hereafter referred as the Act, for the purpose of section 76 and 77 and section 78 of that. Actually, please go through the section 78. It's talking about a dispute resolution panel. The section 78 of the Act, yes, is a dispute resolution panel. How there are disputes between the transfer price in which audit happened, then if there are disputes between the taxpayer and the transfer pricing officer, how to resolve that. then please go through it before the examination. Take 30 minutes and read it and go. Then these regulations operative with effective from 1st April 2018, and with this one there was a earlier gazette notification issued under Act number 10 of 2006. It has cancelled. Okay. Then we will come to the regulations of transfer pricing. Short title and the commencement. This is a particular transfer pricing number 1 of 2018 and come into operation from effective from 1st April 2018. It's with effective from the 1st April 2018. Then what are the provisions applicable to here? First, section 76 and the section 77. Transfer pricing regulations apply to international transactions referred to in section 76 and to the following cases of transactions other than international transactions, that means domestic transactions made between associated enterprises referred to in section 77 of the Inland Revenue Act. Now here from this gazette, section 76 and section 77 both going to cover. What are the other areas? Now how it going to cover? What are the situation where transfer pricing issues can happen? Come to first one. A, if there are tax exemptions granted to any one of the associated enterprise under the particular Inland Revenue Act or under the Board of Investment in Sri Lanka. The first situation it has given the situations where the transfer pricing issues can happen. We will look at as per the gazette notification what are the situations that transfer pricing issues can happen. The one situation is where anyway first thing is a transaction shall be happen with associated undertaking. Associated undertaking. Which kind of associated undertaking, Lamai? It has given one party is exempted from tax. One party, one associated company is exempted from tax. Maybe under 2000 Act, maybe under 2006 Act, maybe under 2017 Act, maybe under BOI Act. Likewise, the transaction is happen between a person who liable, the other associate person liable for income tax. Liable for income tax. Then easily they can have the arrangements. One party is exempted. Then for an example, if this person is doing sales to this one, then liable company is or else we will take like this, this person is purchasing from the exempted company. In that situation, for exempt company, it is a sale. For this person, it is the purchase. Then Lamai, very easily, this liable person can reduce their profit by the recording high value of the purchase cost. For this person, it's a sale. Then even whatever high value of the high revenue is there, is it impact to this exempt company? No, because it has exempted. this is a one situation, one party is exempted, other party is liable, then they are, the first thing is this, the transaction should be happen in between associated undertaking. If so, the high risk of the transfer pricing, if there is something like this. Second one, B, if any difference between income tax rates is specified in any of the schedules to the actor, any income tax rate given in the agreement entered into with the Board of Investment in Sri Lanka according to particular law applicable to one of the associate person. Now this is exempt now. The second situation, it has given the two associated company A and AA. A and AA is a two associated company. Now lamai, A is applying the tax rate of the 14%. A and A is applied the tax rate of 28%. This is the person applying the higher tax rate. This is the person applying the lower tax rate. Then they can be have the arrangements. I will take the same thing if they are purchased from the A, thereby for A it's a sale, therefore lamai to record in high value of the purchase, A can reduce the tax liability because it's the 28%. By increasing the sale of the value of the sale in the under 14%, the tax implication is little bit low. Clear? Then therefore this kind of the arrangement can be happen. That's the second situation. Third situation, if any loss incurred by any of the associated enterprises for the year of assessment or immediate preceding year of assessment which has been brought forward to that year of assessment. The 1.3 situation in the Gazette notification, it has mentioned, this is different tax rates. I will write the topic. This is for different tax rates. Different tax rates, and the 1.3 is, it is for losses. It is for losses. While am I now, I will take transactions between associated person. AB is the company and ABB, the two associated person. Here ABB has a cumulative loss. BB is a tax profit making company. They have a taxable income. They have a taxable income. Clear? Then therefore lamai, I'm again taking the same example, sale and purchase, which is easy. Then ABB is purchasing from AB. Then it's a sale to AB. Whatever the amount of the sale has increased, since there is a cumulative loss for the tax purposes, then even there is accounting profit. By doing relevant adjustment to the converting it to the business income, and finally this business income, due to this huge loss, after deducting this loss, maybe it's for the within the period of 6 years, thereby claiming this loss, the business income will get 0. Thereby the application of the tax rate for this AB company is, for business income there is nothing. When it comes to here, by increasing the value of the purchasing, their income tax liability will reduce by increasing the cost of purchase. In the group perspective, they have obtained a tax benefit. In a second scenario, in a group perspective, they have taken the tax benefit. Even in the third scenario, in the group perspective, they have taken the tax benefit. Clear? These are the three situations where transfer pricing issues can happen. Then in the question, you have to recognize these areas. Now, what's the definition of the arm's length price according to the Gazette notification? The arm's length price referred to in section 76 and 77 of the Act for the purpose of ascertaining income, gain or profits arising in, derived or accruing from, or losses incurred in any transaction, operation or scheme entered into between two associated enterprises should be calculated accordance with what principle? Arm's length principle. The arm's length principle shall be how to understood? Shall be understood as where the transaction between associated enterprises carrying out with taking into account the terms and conditions that would have been used transaction in between independent enterprise. The same definition namai, more or less it is same in the for the purpose of section 77 and 76 and in the Gazette notification. Now come to very important thing, which is the discussion of the transfer pricing methods. Then your answer you have to quote. If the examiner asks for that extender, you have to quote the what is the arm's length pricing which you are going to suggest for this kind of a situation. Come to here. Under arm's length price, there are 5 pricing methods. Then we will discuss one by one. The arm's length price shall be determined by the application of what is this most appropriate method, most appropriate pricing method to the facts and circumstances of the case from any of the methods outlined below. We will look at what are those methods. A. Comparable uncontrolled price method. B. Resale price method. C. Cost plus method. D. Transactional net margin method. And E. Profit split method. Now we will look at one by one. First one is the cup method. First one is the cup method. Come to this first paragraph. The comparable uncontrolled price method consists of comparing the price charged for property or services transferred in a controlled transaction to the price charged for the property or service transferred in a comparable uncontrolled transaction. That's mean to compare with the independent person, the same or similar transaction with reference to price charged for the property or service transferred. Under this method, the price charged or paid for the property transferred or service provided in a comparable uncontrolled transaction or a number of trust transactions is identified. First thing you have to identify the, this is the same thing you have to do in the examination. First thing you have to understand there is a transaction between associated person. Then second one you have to understand the what is the price charge on behalf of this transaction. Secondly, such price is adjusted to account for differences, if any, between the controlled transaction and comparable uncontrolled transactions, or between the enterprises entered into such transaction which would materially affect the price of the open market. Secondly, you have to look at due to this transaction, if there is a material impact to the market value of this transaction. In simply, you need to look at whether this transaction has happened like a transaction it has done with the third party. Make a market value ekata da vela tiyenne. That's the second thing. If not, you have to adjust it to the market value. The adjusted price so arrived at is taken to be an arm's length price in respect of the property transferred or services provided in the control transactions. Then you have to adjust at this control transaction mean independent transactions. Then you should adjust this to according to the independent transaction. That is the comparable uncontrolled price method. Then this is one of the commonly used pricing method. Then resale price method. By looking at the resale mean, you can understand it's for the maybe the buying and selling. Then for the resale, import and selling, local buying and selling. Then it's for the resale activities. Resale price method. The resale price method consists of the comparing the resale margin that a purchaser of property in a control transaction earned from reselling that property with the resale margin that is entered in comparable uncontrolled purchase and resale transaction. Then you have to look at lamai this control transaction. This is I think in earlier one I have made a mistake. It should be control transaction mean the transactions in between associated person. Uncontrolled mean the independent transaction with the other third party. Now in the resale pricing method you have to check resale margin. It's not the price, the resale margin with the control transaction as well as the comparable uncontrolled transaction. Independent party එකක් එක්කයි associate person එකයි එක්ක කරපු resale buying and selling transaction එක margin එක you need to check. Then under this method, now how to arrive the particular independent price or arm's length price. The price at which property purchased by the tested enterprise from an associated enterprise is resold to any person is identified. Now first you have to identify there is a transaction. If you can't identify like that, etanim make iwarai. First you have to identify there is a resale transaction in between associated person. Secondly, such resale price is reduced by an apportionate gross profit margin accruing to the tested enterprise based on the gross profit margin that would be entered in comparable uncontrolled transaction with between unrelated enterprises. Now you have to compare that resale margin with between unrelated enterprise. If I have made the same sale to unrelated enterprise, what is the resale margin or the profit margin I am going to charge? Clear? Then next one, the price so arrived at is further reduced by the expenses incurred by the tested enterprise in connection with the purchases of the property. Any expenditure incurred, that should be adjusted. Then the price so arrived is adjusted to take into account the functional and other differences, because this is like you are doing in we are taking the proxy beta and adjusting it for the calculation parts of the maybe weighted average cost of capital, whatever it is. Likewise, then we need to adjust the same more, because my transaction and the independent transaction is not the same. Therefore, we need to take the the same and similar transaction and adjust it to our organization. The adjusted price arrived at under subsection 4 of this paragraph is taken to an arm's length price in respect of the purchase of the property by the tested enterprise from the associated enterprise. That adjusted price shall be taken as the arm's length price. Then it's on the resale pricing method. Third one is the cost plus method. By looking at the name of the cost plus method, lamai, you can understand this is applicable to whom? This is applicable to more or less the manufacturing organization. That's why there are the cost plus method. And maybe there are SBUs. There are SBUs, two that SBUs, one is manufacturing, another person is purchasing that finished goods. Then likewise even the interdepartmental this can be happen. Okay. The cost plus method consists of comparing the markup. In the resale pricing they are comparing the profit margin. In the cup method they are comparing the price. Here they are comparing the cost or a markup, the markup which we have added to the cost. Markup on those costs directly and indirectly incurred in the supply of property or services in a controlled transaction with the markup on those costs directly and indirectly incurred in the supply of property or service in the comparable uncontrolled transaction. The same thing. You have to compare your transaction with the associated person with the uncontrolled or independent transaction. I am not much going to again the same thing I will describe. First thing, you have to identify there is a direct and indirect cost of production incurred by the tested enterprise in respect of the property transferred or service provided to an associate enterprise. Maybe the property transferred maybe the finished goods, maybe the consultant, the service mean consultancy service, management service, anything. Now the amount of an appropriate gross profit markup of such cost arising from the transfer or provision of the same or similar property or service by the tested enterprise or by an unrelated enterprise in a comparable uncontrolled transaction or number of such transaction is determined. Now our transaction identify, the third party or independent party transaction identify. Now you are doing the adjustment, the same procedure going now. I am not going to touch upon the rest of the part. Then the fourth pricing method, transactional net margin method. We will look at the again lamai the how to apply. I am not going to describe, it has described taking the two pricing mechanisms. I need to tell in which situation these pricing methods are applicable. Transactional net margin method. The transactional net margin method consists of comparing the net profit margin the relative to an appropriate basis such as cost, sale or assets that a person achieves in a controlled transaction with the net profit margin relevant to the same base achieved in the comparable uncontrolled transaction. One net profit margin we need to compare with the independent, the same net profit margin happen with the independent transaction. Now see lamai, this is net transactional net margin method for maybe in the resale, maybe in the buying and selling, the import and selling, any situation this pricing method can be taken into consideration. Okay. Then this is same way how to determine the transfer pricing. Now come to this is profit split method. The profit shall be compared with the particular maybe 5 SBUs in that 5 SBUs there are products. On that products, on the profit, how are we going to compare? The method may be applicable mainly where special conditions have been made or imposing control transaction in see what is the situation, or in multi transactions which are so interrelated that they cannot be evaluated separately. For maybe different SBUs, then manufacturing, for an example, manufacturing plant or the selling the outlets, so these things, one outlet 1, 2, 3, 4. Then we cannot separate these transactions. Then we need to take the profit of these multiple transactions. Under that situation, we are using the profit split method. Then the interrelated, that they cannot be evaluated separately for the purpose of determining arm's length price by any transaction, by which the combined net profit for all of, now for outlet 1, 2, 3, 4, 5, take the combined net profit and compare with the same or similar kind transaction in the combined net profit. Clear? The combined net profit of the associated enterprises arising from the transaction in which they are engaged are determined. The relative contributions made by each of the associated enterprise, that 5 branches, to the earning of such combined net profit are then calculated based upon a reasonable approximation of the division of profit that independent enterprise would have expected. Like in the independent enterprise, what are the profit they have earned in a similar kind of the selling or selling, buying and selling, or manufacturing and selling, whatever the transaction in this, the multiple operation. Okay. Then again such thing we need to compare with the independent party and do the price adjustment and came into the correct transfer pricing method. Then I am not going to discuss the arm's length range, the plus minus comparability factors and how to comparability. Then I need to come for the fifth one, most appropriate method. How are you going to select from this 5 pricing method what is the most appropriate pricing method? In that, for the purpose of regulations 2, what is regulation 2, Lamai? The regulation 2 is the, here we go, arm's length price. For arm's length price, what is the most appropriate arm's length price? Come to here, for the purpose of regulation 2, which is arm's length price, the most appropriate method shall be the method which best suited to the facts and circumstances of each particular control transaction between associated undertaking. These are scenario basis. Now it may be cost plus method if the manufacturing organization, it may be resale price method if the resale activity is doing organization. It may be cup method, it's applicable to any organization because the price is there. If there are multiple transactions with the associated undertaking which we cannot divide, at that situation the profit split method, then you have to select it. How to select? Based on the facts and circumstances given in your examination question. That's why it has given best suited to the facts and circumstances of each particular control transaction between associated enterprises and which provides the most reliable measure on the arm's length pricing. Clear? Then in selecting the most appropriate method, the following factors shall be taken into account. Namely, there are 4 factors to be taken into account. The nature and class of such transaction based on the function performed, the asset employed and risk assumed by associated enterprises entering into such transactions. Roman 2, the availability, coverage and reliability of data. Now, these are in practically we need to collect data. It's not easy to take the same and similar transaction from the market and test these things. Then these are on the assumption basis, we need to do many adjustments on these areas. Then of data necessary for the application of the method. Third one, the degree of comparability existing between controlled transaction and the uncontrolled transaction. We cannot, if my organization is a small organization and in the market there is a similar business organization, but it's a quoted public company, then how are we going to compare these two transactions? You have to look at the extent to which reliable and the accurate adjustment, the plus minus adjustments can be made to account for differences, if any, between controlled transaction and the comparable uncontrolled transactions. Now, the transfer pricing documentation and disclosure form, this is the current, currently these are applying with the income tax return. Then when filing the income tax return, if there are transactions in a particular value of the transactions in between associated undertakings, we shall provide transfer pricing disclosure form. It's essential, it's a compulsory. Okay, now come to here, transfer pricing documentation and disclosure form. Enterprises carrying out control transaction with associated enterprises subject to section 76 and 77, as the case may be, must maintain documents and submit information regarding control transactions, including information on those associated enterprises as follows. They have to prepare and maintain the transfer pricing documentation, the local file, master file, these things I am not going to touch more. The not required of maintaining fresh documents, please go through these areas. Submission of transfer pricing documentation, I will come it with the transfer pricing disclosure form. Then preparation and submission of transfer pricing disclosure form, I will come to annexure the 4 and I will explain it. Then submission of country by country report, these I am not going to discuss, but I need to come for the this part. Then this is on country by country reports. Penal provision, please go through this paragraph F, penal provision. Even from the Inland Revenue Act, we have discussed all penal provision relevant to transfer pricing regulation. Therefore, the particular sections has referred. Can you see? We have discussed these things. Therefore, I am not going to discuss this again. Then this section 184, all penal provisions we have discussed. Therefore, please go through that. And next I need to come for this one, paragraph 8 discussion. Associated enterprises. For transfer pricing requirements, what is the definition of associated enterprises? Now we have, in the first section 196 is talking about associated person. After that, for transfer pricing purpose only, section 76 and 77, there is a person definition. Now we need to look at, according to the Gazette notification, what is the definition of associated enterprises. Come to here, for the purpose of section 76 and 77 of the Act, and for these regulations, two enterprises shall be deemed to be associated enterprises if at any time during the year of assessment any of the following condition is met. There are a lot of conditions to meet. We will go one by one. any person or enterprise hold directly or indirectly shares or otherwise carrying the majority of voting power of the other enterprise. This is you all know. The 50% or more on the stated capital or voting power is there, then it is associated. Secondly, any person or enterprise holds directly or indirectly share carrying not less than 50% of the voting power. It is not less than 50% of the voting power. This is talking about lamai directly or indirectly shares or otherwise carrying on, what's the word in majority of the voting power. Here talking about the not less than 50%. That means at least there should be a 50%. Third, loans advance. Now see how all the things are included. Loans advances by one enterprise to another enterprise constitute not less than 51% of the book value of the total assets of the other enterprise, provided that it is not given by the bank, which is not considered an associated enterprise under any other item of this regulation. Now, I am the borrower, I have borrowed the loan from my associated undertaking. The value of the loan is the it's a not less than 51% of my book value of total asset. By the person I have taken the loan, it's not the bank, it's my associated person. Okay, in that situation it is considering as the associated person. That's why Lama it has very clearly given provided that it's not given by a bank. Okay, bank it is it's their business, then anyway they have to provide it according to their regulation. Bankuak nemei na, then it is associated. Then loans and equity provided by one enterprise to another enterprise constitute not less than 51%. Adu metana kiyanne constitutes not less than 51% of the book value of the asset. Here the loans and equity provided by one enterprise to another enterprise constitute not less than 51% of the book value of the total asset. Metana loans and advances, here loans and equity provided. Then E, one enterprise guarantee not less than 25% of the total borrowing of the other enterprise. When the providing of maybe financial assistance, one company guarantee not less than 25% of the borrowing of other enterprise, then it is associated. More than half of the board of directors, even this is there in section 196 also, more than half of the board of directors or members of the governing board or one or more executive directors or executive members of the governing board of one enterprise are appointed by the other enterprise. Then more than half of the board of directors or members of the governing board or one or more of the executive directors of the members of the governing board of each of the two enterprises are appointed by same person or persons. Then even the appointments we have to look at. And 90% or more of raw materials. Now see Lamai how for the transfer pricing purpose, how they have the design or describe the associated person. Almost all the transactions they have included. 90% or more of the raw materials, semi-finished goods and consumables required for the manufacture or processing of goods or articles carried out by one enterprise or the purchase required for the sale are supplied by the other enterprise. There are intercompany sales, there are intercompany purchases, as I have explained. If it is the 90% or more, then it is associated undertakings. Now next one, the goods or articles manufactured or processed by one enterprise are sold, transferred to another enterprise or to person is specified by the enterprise, and the prices and other conditions relating thereto are the influence by such enterprise or vice versa. Then on the goods or articles manufactured or processed by one enterprise, the transfer in happening. Then now think like this, there is a company A, company B. Company B is doing export. Company A is, these are associated person. Company A is the sole supplier of the raw material to this export. At that time, company B cannot survive without having a company A. Then in that situation, it is associated. Then J, I think it's yes, where one enterprise is controlled by an individual or jointly by such individual and his relatives, and the other enterprise is controlled by such individual or his relatives, or jointly by such individuals and his relatives, or jointly with relevant relatives or such individual. This is a family owned company. Then the same individuals are there, they are influencing the organization, then it is associated. Where one enterprise is a firm association of person or body of individuals, the other enterprise holds not less than 10% of the interest in such firm, association of the person or body of individuals. That means think here like this, it's talking about one enterprise is a firm, association of persons or body of individual. The other enterprise holds not less than 10% interest, at least a 10% interest, maybe interest in shares. It's not given the particular the asset, it's talking about the interest. Then maybe it's shares, maybe on a particular asset, anything. Then if it is a 10%, then it is associated. Where the control transaction differs from the transaction that would have been made or imposed by any person not directly participating in management, control or capital as mentioned in section 76, 77, but confers the potential advantage of the enterprise. Nothing, it is in like the previous paragraph, even it's not control, anything not doing, but he has the interest, but confers the potential advantage to the enterprise. Maybe the top person, maybe the founder, maybe the chairman. Then if he can influence the all these activities, then it is associated. Now I underline or highlight this, all the areas what I have discussed with the gazette notification, the associated enterprise, the how it's become the associate for the transfer pricing, it is very critical. Then next one in the paragraph 9 and the paragraph 10 I am not going to discuss, but I need to go for the transfer pricing disclosure form. I need to go for the transfer pricing disclosure form. I am not going to discuss all these things. Then this is the formats of the transfer pricing, the documentation. You can see this. Now I need to come for annexure 4, transfer pricing disclosure form. In terms of paragraph D of regulation 6 of the gazette notification, we have discussed it. Section 76, 77 and according to 194, which is regulations of the Inland Revenue Act number 24 of 2017, this is the transfer pricing disclosure form, this is the format. But I see what should be disclosed. Disclose is the transactions with associated enterprises. What are the things you should disclose? Transaction, who is the associated enterprise, what is the transfer pricing method adopted, then in that after adjustment what your arm's length price. Clear? Then category of transaction, amount for loans, principal amount for loans, ending balance. Name of the associated enterprise, TIN number, country of residence, Criteria of associated enterprise. Transfer pricing method, these are the profit level indicators. This is given in the Gazette notification, how to do this, and what is the arm's length price. It is a transfer pricing disclosure form. Now, these are the transaction you should disclose under the transfer pricing disclosure form. I am taking a one. This is talking about a revenue transaction. That's mean one party. It's a revenue. Then sale of products, inventories, sale of non-product inventories, the production of supporting services, administration services, all are included. And you can see it's other services. Then here other asset, other revenue, all are, any transaction has included. This is the expense transaction, like for the revenue transaction. Samely there are expense transaction. Then these are the types, they have put the codes for the transfer pricing disclosure form. Now I really need to come to here, Annexure 6, transfer pricing disclosure form, completion requirements. At what situation we must complete and submit the transfer pricing disclosure form. The following is the guidance for the completion of the transfer pricing disclosure form. All taxpayers that carry out transaction with associated enterprises during the year of assessment must complete and file a transfer pricing disclosure form. Regardless of the size and nature of those transactions, the following conditions apply. What are the conditions? All taxpayers that carry out categories of transaction that exceeds 200 million must complete all fields of the transfer pricing disclosure form. If it is exceeds 200 million, you have to fill this all 4 parts. All 4 parts, column 1, column 2, column 3 and column 4. Clear? Then those taxpayers that carry out categories of transactions that do not exceed 200 million only, column 1 and 2, that's mean the transaction and the name of the details of the associated person. Okay, transaction and the associated person. This is the that I need to tell you all the maximum transaction value which you are liable to complete the transaction and the associated person, the column 1 and 2. Then associated enterprises, these are the list of codes given to fill that disclosure form, and these are the for the 5 pricing methods, these are the short forms given. These are the profit level indicators given, lamai. Then profit level indicators, I think this ROTC has tested in your paper, the operating markup or return of total cost, something it has tested. Then for your March 2021 thing, then these are the important area. This is a very long Gazette notification, but I really need to take the very important aspects of this Gazette notification and do this for you. Therefore, please take this, and before the exam, please have this and take this with you all at the time of the examination. And I have mentioned how to write the answer. First, you have to identify the are there any associated person. That's the first thing. If there are associated persons, secondly, you should identify are there any transactions between these two associated persons. Thirdly, due to these transactions, are there any exposure to transfer pricing risk? What is the transfer pricing risk? Transactions are transactions in between associated person, not in the arm's length price. Clear? Then if so, there is a transaction issue. You have to identify the transaction and tell there is a transfer pricing issue. If not, after that you have to identify the transfer pricing issue and you have to provide the recommendation. What's the recommendation? You must provide most appropriate pricing mechanism. Under arm's length pricing, the 5 methods are given. Then you have to, normally in the question it has given what is the, if it is a cup method, the examiner has given a similar kind of the transaction which done with the independent third party. Then you should smart enough to take this and write if the transaction between the XYZ private limited, the same value we have to take into the take this to the arm's length or the most appropriate pricing method. Under maybe most of the cases is cup method, but other methods also can test it. With this theory areas, please go through the pilot paper question 1 part C, that all things I have discussed, therefore I am not taking it again here since it has done, okay. Then and also in the December 2020 online paper question 1 last part for the transfer pricing, that part also I have discussed. Therefore, please go through that areas again. In the transfer pricing, as mentioned, section 33, section 76, section 77, definitions and the transfer pricing gazette notification, everything I have discussed with you all. Then this is the end of the discussion of theory session 8 as the transfer pricing regulations. Thank you very much.